Welcome to Multnomah Group's review of the capital markets for the first quarter of 2021. My name is David Williams, and I'm a senior consultant at Multnomah Group, and I also chair our internal investment committee. As we start our discussion, I'm going to focus on the U.S. economy and the global economy and the continuing economic recovery that we are seeing. As we ended 2020, the U.S. economy grew at 4.3% on an annualized basis during the fourth quarter. Early expectations for the first quarter are to see continued growth at around 4 to 4.5% annualized growth rate. The expectation is for growth to continue throughout 2021 with outsized growth relative to historical norms. From a consensus basis, U.S. unemployment ended the quarter at 6%, which is down from 6.7% as of the end of 2021. Just as a reminder, during the pandemic last year, between February and April, the U.S. economy lost just over 22 million jobs. We have recovered a significant amount of those, just under 13 million jobs from May through the end of March, but we still are short, millions of jobs relative to where we were going into the pandemic. Job growth here in the first couple of months of 2021 has been strong and a bit ahead of expectations, as we saw non-farm payrolls at about 916,000 jobs in March. As we continue to review first quarter, fiscal policy and Fed policy continues to be a strong driver of the economic activity here in the U.S. On the fiscal side, we saw the American Rescue Plan, the $1.9 trillion pandemic relief policy, which is highlighted by the $1,400 checks, that passed in March. And has been instrumental in some of the increased consumer spending that we saw during March. The federal government is also focused on other items, as we are now learning more about the American Jobs Plan, the proposed $2 trillion infrastructure plan. And then the Biden administration has begun discussions of the American Family Plan, which will be another policy measure that they are looking to implement or propose to Congress later this year. From the Fed standpoint, the Fed continues to be very accommodative. We saw no policy changes during the first quarter. The Fed funds rate is expected to remain low or near zero through most of 2021, although many market participants are anticipating that the Fed may have to raise rates faster than they are currently forecasting, given some of the concerns around inflation. The Fed remains fairly confident in their ability to keep rates low, as they are supporting return to full employment, and they are also comfortable in their reports with a slightly higher than normal inflation rate. On the long-term side of the interest rate curve, the Fed is continuing asset purchases, mostly of Treasury and mortgage-backed securities, although some are expecting that to taper off into 2022. One of the big headlines that we saw this last quarter was a return of inflation. And I think it's important to note that year-over-year comparisons of inflation are something to be taken with a grain of salt, given the significant drop in prices that we saw at the beginning of the pandemic. So looking at simply year-over-year comparisons may provide some additional noise, given what we saw with energy prices as we led into the pandemic in early 2020. But with that said, headline CPI, which includes food and energy, was up 1.7% in February year over year, and up 2.6% in March. year over year. So, the Fed long-term target around 2%. We certainly are seeing now inflation above that on a year-over-year basis, but again, needing to keep in mind the sensitivity to when inflation fell in the early part of 2020 as a result of energy prices coming down significantly. Additionally, here in March, we've seen rising consumer confidence as a result of kind of the reopening, higher vaccination rates, more economic activity, increasing, I guess, the drop in unemployment. Retail sales were down in February, largely due to the winter storms that were experienced in the South, as well as just general a slower reopening. But what we did see is in March, retail sales jumped fairly significantly, up about 10% during the month of March, again, being largely pushed, or I guess being largely credited to those $1,400 checks that were part of the American Rescue Plan. With this background, let's jump into the capital markets. And so starting with the US equity markets, the S&P 500 was up 6.2% for the quarter. We saw value stocks outperform growth stocks and small outperformed large capitalization stocks. And this is a continued trend from the fourth quarter. This is largely being pointed to as the reopening trade, as more vaccinations, lower death rates, more stimulus is being added to the system, has resulted in the upper left-hand corner of this chart. You can see that the more economically sensitive sectors of the market outperformed during the quarter. Again, a similar trend to what we saw in the fourth quarter, as energy, financials, and industrials led the way. Whereas for most of early 2020, we saw those technology and consumer discretionary and communication services sectors lead the way. Bottom of this chart, we look at returns from a style and capitalization standpoint. And again, for the quarter, value outperforming growth, small outperforming large. If we look at over on the right-hand side at the 1 year, you see that, again, growth outperformed value, but that amount, the delta there narrowed significantly compared to what we saw in the end of 2020, second half of 2020. So that value versus growth trade has come back a little bit closer to parity, given what we saw in fourth quarter and again here in and again here in the first quarter. On a valuation basis, the forward price earnings ratio for the S&P 500 is 21.9 times. That's a slight decrease from the fourth quarter. The long-term average, the 25-year average, is 16.6 times. So stocks are still expensive still remain expensive relative to historical averages for the S&P 500. As we flip to the fixed income market, the Barclays Bloomberg US Aggregate Bond Index was down 3.4%, largely being hurt by rising interest rates. So interest rates increase has an inverse effect on the performance of fixed income securities. For the quarter, we saw the yield curve steepen. So yields on the short end stayed low. And at the 10 and 30 year portion of the curve, we saw an increase. On the 10-year, kind of a bellwether interest or term for mortgages, as well as kind of those longer intermediate term bonds, the 10-year note was up 81 basis points to 1.74%. For the quarter. We saw that credit spreads narrowed for investment grade and high yield, the improved outlook for the economy, so reduced concerns about default, particularly in high yield. And it remains really a challenging environment for bond investors. You can see here In the upper left-hand corner, negative returns across the board, with the exception of high yield for the quarter. Looking at it longer term for the 1 year, the Barclays Aggregate Bond Index was up, 0.7% for the full year. Certainly a challenging environment as interest rates look to be on the rise. So we jump forward to the international equity markets. Improving economic outlook for the globe beyond the U.S. We did see that international markets were positive, but they did lag the U.S. So the MSCI All Country World ex-US Index was up 3.6% for the quarter. Developed markets were up 4.2%, where emerging markets were up 2.3%. So a reversal of what we saw in the fourth quarter, with developed markets leading the emerging markets for the quarter. Again, I think something that we see commonly referred to here for this is that vaccine rollouts have been stronger in developed countries than in emerging markets, and therefore there's a little less economic activity going on in those developing countries. Additionally, the dollar appreciated relative to the basket of international currencies, which hampered U.S.-based investor returns for non-U.S. equity investments. On this slide, we talk about the unpredictability of asset class returns. So what we show is the major asset classes that are used in retirement plans on an annual, and the returns for those on an annual basis. As we look at the beginning here of 2021, what we'll see is that small cap stocks are leading the way, which is a continuation of 2020. Very strong returns for small cap stocks, up 12.7%. But we also are also seeing a rebound in some of those more inflation sensitive assets of real estate and commodities, up 8.5% and 6.9% respectively. Equities continue to be strong performing asset classes in this environment, given the very, very low interest rates. And you can see it's a very, very challenging environment for bond and principal preservation investors, given that rising rate environment. As I end, I just want to thank you for joining our discussion of the capital markets. And if you have any questions, please don't hesitate to reach out to either myself or your Multnomah Group consultant. Thanks for listening and have a great day.